live on YouTube and then we start the session. Is it? Thank you. So again, good morning to everyone. My name is Gavin Picardo. I will be your host for today. This event is organized by Aegis Granville Award, the largest innovation ecosystem for innovations in India. And this has also been co-organized by Aegis School of Data Science, Cybersecurity and Telecom to develop cross-functional leaders in tech, and supported by our tech partner, MUNI Campus for this event. Today, we would be learning from an inspirational guest, Mr. Aniket MJ, with Idea Spring Capital, an initiative to support, the startup and innovations in large firms. Here, he's contributed to the growth and startup from early stage to growth stage to late stage. He has worked with several venture capital firms, family offices, global investment bank. Privileged to host you. Thank you for joining. And it's always also a privilege for me to host someone like you because you learn from the best. And when I say learn from the best, is the best universities. It's among the top 5 universities, if I'm not wrong. He has done his MBA from Oxford University. And a pleasure to host you. Let me just share my screen and just help you to let you know about the agenda as well as about the partners here. Just a minute, let me share my screen. A minute. So this event is as an intention to support the ecosystem of startup and intra-entrepreneurs in the organization. The award is supported by the Ministry of Electronics, IT, Niti Aayog, and Ministry of Skilling and Entrepreneurship in the banner of Skill India. This is the 13th edition. We've been doing this from past almost a decade now. And this initiative was started by Aegis School of Data Science. Is a leading exponential technology institute providing higher education, consulting, and executive education. They are on the pioneers in terms of facilitating the skill gap in the country, I would say. And we do have Mr. Daria as well from the Aegis School. Good morning, Mr. Daria. Good morning, sir.
Good morning, Gavin. And good morning, Mr. Aniket. Welcome to you. Thank you so much for agreeing to conduct this session. I think all of these participants will really love and benefit from this. Thank you so much. Welcome to you.
My pleasure. Thank you for having me.
Thank you. And we also have this event. I'm sure most of the participants have viewed this MUNI Campus because this MUNI Campus is not just a registration portal for us. As one of the feature, what you'll have been seeing, education is one of the key areas or the key pillars of the economy, and MUNI Campus is trying to support the traditional methods to making it more digitized, and that's what the MUNI Campus does. It's a mission to eradicate the birth penalty by giving a quality education and accessible to everyone, with making this institutes as well as education ecosystem itself to digitize and scale the digital infra. That's our tech powered by MUNI Campus. And about the partner, Idea Spring Capital from Aniket Hills, and he leads also the Idea Spring Capital, is one of the focused on investing in early stage technology, which also they fund ideas. We could see some of the good names in the sheet here, in the slides, which also says MeHub, which is an NLP startup. We have Worksfolk, we have Label Networks. These are some of them. I'm sure it could be a unicorns. And great to have Idea Spring Capital leader, Aniket, to support this initiative, to guide and build an ecosystem to flourish it. The startups, the co-founders who wanted to learn something, and something I would call as the cheat codes. I seems Christmas is early for us today because I'm sure everyone is busy in this Secret Santas and this Christmas vibe. Christmas vibe is all about hope and happiness. And I'm sure with this session, we would surely get a hope how we gonna go with this and happiness with, I see the content a bit from Mr. Aniket. I'm sure it could be a very great and enthralled to see the session which you would be conducting. Along with this, we would request leaders in the participants, don't just put your questions in the chat box. Let's make it interactive. Turn on your video, ask questions, oppose the session, and let's make it more interactive. If the ones who have low connectivity, we understand that. I'll be your support. We can guide you then. Why we do this session? Because of our partners like this, because we are promoting a lot of innovations from our partners, which is SwissNext, which is a Switzerland based consultant, and also there are many more partners who are supporting this mission, is because AGB has witnessed a lot of unicorns because of our initiatives, what we have done so far. And because of certain initiatives, these leads to a next generation. We have games, Unifor, Misho, PhonePe. These are the companies who participated, and where same way in the way you are seeing it yourself at the moment, where we're getting interactive sessions from the leaders like Aniket and being watching the sessions as well. And from there, they are lead to be the unicorns in the world. And happy to have the session. I would ask Aniket to please share the screen and welcome you for the masterclass.
Thanks a lot, Gavin, for the intro. Let me just share my screen. Yeah, is my screen visible?
Yes, it's visible.
Perfect. So I think Gavin gave me a lot of credit, and I hope to repay some of that by making this as insightful as I can. So and I think, like he set context as well with regards to making this interactive, I'd also appreciate that, because it always helps to get some sort of a feedback or pulse in terms of whether this is on track with regards to what you're expecting, or if there's some other areas that I could cover as well in the time that we have here. So I'll get started. So how I thought I'd structure this today is, I thought I'd go a little bit over my career journey, because I'm now in an investing capacity at IdeaSpring Capital, but it wasn't always the case. A lot of my career was spent in operating roles. So I'll touch upon a little bit about that. I also thought it made sense to talk about the company that I work for today, which is IdeaSpring Capital. And the reason is, I think venture capital is a large umbrella term, and there are firms, venture capital firms, that have different theses that operate in different stages, sectors, etc. So a lot of my perspectives that I share today are also from the purview of what IdeaSpring Capital does, and that's important for you to understand as well, to know that this isn't a one-size-fits-all template that I'm presenting, but for startups in our sector that we see, this is something that we appreciate, and I thought I'd go over that. I think with regards to the audience in the room today, I'm not sure how many are already entrepreneurs or how many are looking to get onto the path of entrepreneurship. So some basic pointers I thought I should mention about how to reach out to a VC, etc. Might make sense if you've never reached out to a VC before. If you have and you're already connected well with the ecosystem, then this might be a bit redundant. Then I thought the two parts that I thought we should spend most amount of time on is on pitch deck construction, which is largely how would you structure content that you're looking to sort of showcase to investors. And then I'll give you my perspective of how an investor perceives that context or content and does what we call due diligence, which goes deeper into a venture that you are potentially presenting to us, and we take that decision therefore to invest or not. I've kept aside some time for Q&A right at the end, but if you do have questions in the middle, I'm happy to sort of answer that as well. So this is largely been my journey. I've purposely not mentioned it in chronological order. The top half is actually in chronological order, which only talks about my venture investing experience, largely short stints in a lot of VC funds in the form of internships, part of my MBA. So I started off with Artiman Ventures way back when I was a 20-year-old, actually about 19 or 20 years old. I did a 1-month internship there, spent some time at my family office, which is Dhwani Foundation, where we invest in early stage startups. Just before my MBA, I interned at a Bangalore-based venture fund called Seed Fund, did a 2-month internship there. I studied at Oxford for my MBA 2014-15. Oxford has a student-run venture fund called the Oxford Seed Fund, where they pick 10 students every year, give them some money to manage, and you invest in the Oxford ecosystem. So basically, startups started by Oxford alumni, faculty, students, etc. So that was good practical experience to venture investing while learning theoretical subjects during my MBA. I then interned at another venture fund called Capricorn Investment Group, which is again in the Bay Area. And then from 2021 onwards, I transitioned to the venture space full time, which is where I'm at today, and that's at IdeaSpring Capital. And I've been here for the last year and a half or so. This has been sort of complemented with a lot of operational experience along the way at well-established firms and at startups. So started my career off at Goldman. So I have about 8.5 years of experience in the corporate side and about 3.5 years experience on the startup investing side. So totally about 13 years experience. So I started my career at Goldman Sachs, largely an operational role in their asset management division. Decided that the startup spaces of interest. I'd done the internship at Artiman and I'd spent some time at Dhwani Foundation, which is my family office, and decided to join an early stage startup, which is Life is Outside. Travel startup, did everything from serving coffee to walk-in customers and doing business development and product management for them. Post my MBA, I decided India was on a path to recognizing good sort of startups that were ingrown from within the country. We'd seen validation of that in the years 2015, 2016 by seeing startups sort of becoming unicorns, etc. The early wave was companies like Flipkart, Paytm, Ola, Zomato. So I wanted to work in one of those companies. So I was part of the global growth team in Zomato, which helped launch a new product vertical for them. So spent a little under 2 years with them. But Zomato was already a big company by then. It hadn't become a unicorn, but it became a unicorn during my time there. And after that stint, I had the confidence to want to do that again with a smaller startup and take that same journey. And I joined Bizongo then in 2018, and I spent 2.5 years there in their leadership team, looking at 2 different verticals, but was part of the whole journey right from their Series A investment to the time they got to their Series D mark. And I left the company then, but the company is very much a unicorn right now and is likely to become a unicorn in the upcoming months. So I thought I'd set this context in terms of where my perspectives are shaped from, which leads me to a little bit more about IdeaSpring. So again, it's important to understand that venture funds have certain areas that they are focused in, certain sectors that they are operating in. Some are sector agnostic, can operate across the spectrum, can write early stage checks, can also write late stage checks. But we have a focus. Our focus is we are specifically focused on seed stage companies, which means very early stage companies. We only operate in the B2B sector, and within B2B also, we only operate in what we call enterprise product innovation, which is, I would say, biased towards software ventures that are catering to the enterprise market. But we could do some hardware as well, but we don't really do B2C. So that's where we sort of draw a line. And the reason to have a focus also is that you can become sort of a subject matter expert in a particular area. And when new startups come up in that space, they perceive you as an investor who isn't just providing capital, but also could help them by mentoring them, guiding them, and connecting them to relevant people in the ecosystem to help them to grow. So that's the idea behind getting this focus for us. And also the founders of the firm have had an illustrious career in specifically the enterprise ecosystem space and have done startups of their own. So their experience and the experience of people like me who sort of come along the way in the recent past as well, we want to therefore play a part in the growth story of startups that cater to this particular focus sector. So funds operate or venture capital companies operate on a fund to fund basis. So we launched our first fund in the year 2016. This was roughly 117 crore fund. We made 16 investments out of that. Exits are when we end up seeing returns on our investment, because we invest it all in the form of equity. So we only get our money back when the company that we have invested in has some sort of a exit event. It could be an acquisition or a merger or an IPO, or somebody just buys out our portion of the company. So we've already seen 4 exits. Exits are typically good reflection of the fact that you invested in companies that have a value outside as well. So we've seen 4 exits. We're likely to see many more. A lot of our companies are doing well. Sometimes you may want to hold back on an exit because you believe value creation is going to happen down the line. So a lot of our companies that we invested in out of these 16, I would say, have grown well enough that even if you've got inbound acquisition interest, we want to continue staying invested in them such that we can maximize that at a future point. So all of this, in terms of the conviction we had to operate specifically in this area, led us to launch our second fund in July of last year. That's when I came on board as well. Our second fund is more than 2 times the size of our first fund. We again want to stick to the same sectors because we believe we've had some little bit of validation for the thesis that we laid out earlier, and the initial success that we've seen with that, we want to double down on that. So again, we want to invest in about 16 to 20 companies. We'll write slightly larger checks. So we were writing roughly anywhere between 500K and 750K to begin with. With the second fund, we can go up to $1 million, $1.5 million. So we write larger checks upfront, and but otherwise we pick companies in more or less the same way, and I'll touch upon more on that. We specifically care a lot about technology. I mean, I think every firm says that they have a bias towards investing in tech companies, but we specifically look for product differentiators, technology differentiators. Our companies that we invest in, we rarely ever, or we don't actually invest in any company where one of the co-founders isn't also leading technology or isn't leading product by themselves, because we believe tech and product is part of the IP of a company and it needs to be in-house. I'm not saying it's the only model, but it's a model that we believe has a lot of merit, and we prefer working with companies that do a lot of this in-house. So that's again one particular bias that we have, and one of the parameters that we use to sort of evaluate. In addition to that, once we invest in a company, our job is not done. We have something called as a startup assist program that allows us to work closely with the companies that we invest in to, over a period of time, to help them really sort of maximize value. And that's also a reason why startups reach out to us directly to want to partner with us rather than go with some other firm. Yeah, so largely that, which so about my background and the company that I work for. So this is just some pointers that we see from our purview, and also from the standpoint of you might have seen a lot of articles on this online as well, but I thought it's important to cover some of the stuff. So I mean, I think each entrepreneur is passionate in the venture that he or she has started, and I know it can be disheartening when you write to an investor seeking money, but they don't respond, or they probably dismiss the startup without having looked through it very, very closely. But I thought I'll share some numbers in terms of that. So as a VC firm, we get a lot of inbound requests in terms of decks that we need to be evaluating. So we track this on a close basis. So our firm specifically easily comes across about 250 decks on a quarter-to-quarter basis. And it's just a 4-member team here on the investment side that looks at those, of which some of us sit through a majority of them. So 250 decks, I know each entrepreneur must have spent a lot of time to craft out that perfect story, but to get noticed, you need to potentially find creative ways by which you could be the one shining sort of stone in potentially a larger pile of other companies that are there. So to be noticed amongst that 250, how do you get noticed? So I would say out of the 250, we end up at least scanning through all of the decks. If it is a cold inbound, in which case we don't know anybody from the founding team, and they've just reached out to us, it's not come through any reference. I would say on an average, we spend 3 minutes on a deck, and I'm sure the story of the startup and what they want to do and the mission and all of that cannot fit into, or me spending 3 minutes cannot justify what the larger purpose of the company is. But unfortunately, that's just a function of the bandwidth that we operate with and a lot of other VC firms operate with. So it's always advantageous, therefore, to go through a known person, because we end up spending more time, because that's one more check in terms of validation that we have, that somebody else vouches for this company. So, and also I think with LinkedIn and all of that, I think it's easy now to identify people who could be your flag bearers of sorts. So wherever possible, I would say, spend that few extra minutes, spend that extra time to try and identify someone who can take you in front of a VC firm, because I promise you that's something that we look at more closely. It may be fair, may not be fair, but that's what it is, and I thought you should know that. Also, I think we end up seeing, I mean, the third point covers basically a lot of times entrepreneurs are enthusiastic about showcasing all that they want to do, and it's don't get me wrong, you're supposed to be enthusiastic, passionate about your idea, but there's only, if you tie it back with the above two numbers, which is we spend on an average 3 minutes on a deck, and we go through 250 decks in a quarter, in addition to the other work that we do. How best can you compress your message to convey all that you need to do in 3 minutes? So we've seen long 60-page decks, 60-page reports coming our way that talks about everything that the company is doing, goes deep into the technology and all of that, which is great. I like the level of thoroughness, but is it required in the initial time that you sort of reach out to VC? Maybe not. I would say some of that could come up later. And again, I think it differs from the stage of startups. If you're seeking funding for the first time, maybe it's not required. But as you grow more and more, if you're seeking an audience with a VC investor for a Series B or a Series C round, that time maybe that level of data is required. But a lot of what we do upfront, I would say, if in 10 to 15 slides you're not able to crisply, concisely sort of communicate what is it that you are doing, and we'll get into the what's of it in subsequent slides, I would say the chances of you shining and being one of those shortlisted decks in the 250 is very, very low. So get it, and it's I would say it's a skill that can be acquired, can be practiced and perfected over a period of time. So definitely focus on communicating all that you need to, but in the shortest possible way. Pointers on each slide. Again, we don't like too much of text, because we don't end up then spending, because I mean, if you see 3 minutes, if you're spending on a slide, and a slide should only have, a deck should only have 15 slides, we're not spending too much time on a slide, right? I mean, it's roughly in 10 to 12 seconds, I need to understand what is it that you're looking to communicate. So 30 to 40 words at most. I think pictures definitely help, graphs help. So all of that, incorporate more of that and lesser so of text, so that your message can be sort of articulated more clearly. You've all heard of elevator pitch, but cocktail party statement is something that I thought is more relevant. We end up attending a lot of these mixer events where we meet with startups, and it's in a loud environment, and a startup basically has about 30 seconds or so to tell you what is it that they do. And if they get into, so I think the iPod example was a great example. I think when Steve Jobs launched the iPod, he didn't come up with saying that, hey, I've launched this device that's on that has this much of memory, and that's this much in terms of dimensions. I think the message was that for the first time, you can carry 1,000 songs in your pocket. And a lot of the other things are largely product specs or features that I would say you can keep for a later discussion, but you need to have that. You need to have that one line about your startup. That's great. Also, I think a lot of people in these short 20-second, 30-second conversations benefit from anchoring their product to something that's already proven. So, for instance, everybody now knows what Airbnb does, but if you could say you are like the Airbnb of work, for instance, that's something that me as an investor will be able to relate to. And if it fits in my thesis, then I'd want to speak in more detail with you. So something like that, I would say perfect that one line statement as is with regards to what is it that you do. And rarely is it about your product or your this thing, but more about an emotion that you're trying to create. And that I would say is something that needs to be catchy and is something that you again practiced and perfected over a period of time. Any questions on this, or should I move on?
Exploring, if you all want to have a question so far, we can initiate a Q&A segment, or we can take it later.
Okay, sure. Whenever you feel like also asking questions, maybe you could also list it down somewhere, and I can ensure that I don't miss out on it.
In case you want to ask, anyone of you want to ask question, if you could just add this raise hand button in the Zoom, and we can take up the question there.
Sounds
I'll
good.
keep
So
it watch.
I'll continue on then.
Sure.
So in terms of, I think the topic for today's discussion is largely around what should a pitch deck comprise of, and all the columns on the, I mean, all the points that I mentioned on the right column, I would say you all might have seen it in a pitch deck, but I would say some are definite must-have, some are nice to have, and some should potentially be avoided depending on the stage that you're at. So going into must-haves, again, I'll share perspectives largely from an early stage startup. So you are someone who's raising money for the first time, reaching out to an institutional investor like us for the first time. And I think and if you need to communicate that message like we discussed in 10 to 12 slides, I think what should immediately sort of come across is clear articulation of what the problem statement is. It could be as bold as, hey, I believe this is broken today, and this is a problem for so-and-so people, and I'm coming up with a solution to solve for it. That articulation, I mean, it sounds very simple, but a lot of startup decks don't have that. So we go through slides and conversations, sometimes over the course of even an hour-long conversation. I'm not sure I understand what the problem statement is at the end of the day. I think that is something that more often than not VCs want to see, because again, clarity in the mind of the entrepreneur is a great plus point for the VC as well, because we believe that even going down the path, if we were to invest in you, you'd end up having situations where there'll be a lot of ambiguity, and that clarity of thought is useful to have, and that can be seen right from the first time you present to a VC. So as a sort of continuation to the problem statement is basically what is your product or solution, and timing is very important. And by timing, I mean, I'll give you an example. So we invested in a AR VR company about 5 years back, and now with the metaverse and all of that, I think the relevance of a solution like that is more, or the relevance of it is higher today than it was back then. So the technology was great, the team was great that we invested in, but it's just that the timing of the solution with regards to market's acceptance of it is different today than what it was then. So your product or solution, when it is coming out, it is the timing of it. You'll need to try and show why today is the right time to sort of launch it. So you all know when COVID hit and the first wave of masks and PPE kits all came about, a lot of companies got into coming up with solutions to sort of fulfill that supply chain. It was relevant for them, and I think a lot of people who caught on to the potential demand from something like that very early were able to really benefit from it. But if somebody launches a startup today with PPE kits and masks. And I'm not saying the importance or need for it is completely sort of reduced, but it's at a point where the market is fairly crowded. The demand for it is also fairly weakened. So timing, therefore, is important from that standpoint. I mean, today, is there a burning problem that needs a solution, and do you have that solution, and can you launch it in quick time is important to assess. I think a lot of companies, third point is a lot of companies end up saying they want funding, but they don't really mention how much. Again, it's important to mention that because each investor has a different appetite. So like I was transparent about how much we tend to invest. So we invest up to $1 million, $1.5 million. We end up, so if you're looking to raise, let's call it 200K, we don't end up encouraging, or we don't end up being the right partner for you in such a scenario, because you are seeking an amount that does not fit into our sort of financial dynamics. So for us to return the money on our fund, we need to invest in that range of 750K to 1.25 million. So, and also if you only need 200K, which is perfectly fine, you're probably better off going to angels and then coming back to us at a later point in time. Similarly, a startup that wants to raise a big round upfront, 5 million, 10 million, need not or should research enough on the VC to figure out whether this VC will participate in a round like that, because we'll never do a round like that, because we won't get the desired stake in the company if we were to participate in a 10 million round, because the company has to dilute equity to give to the investors that are coming in, and we typically want anywhere between a 15 to 20% stake in the company, and we won't get that in a 10 million raise when we are ready to contribute only $1 million, $1.5 million. So that exact funding ask is important. I think another mistake that startups make there is giving a range. I'm ready to raise anywhere between 4 to 6 million. That again is ambiguous, because 4 and 6 million is there's a big gap between the two. So if it's a 4 million raise, I could potentially participate. If it's a 6 million raise, I definitely won't participate. So again, each investor could look at that differently. So I think you as an entrepreneur needs to have a plan on how you're planning to utilize that capital once you get it. So once you get the money, you need to figure out what you're going to, or before you even get the money, you need to figure out what is it that you're going to spend on, and how is it helping you get to your milestones in terms of revenue, etc. So if you think you can do that with 4 million, ask for 4 million. If you think you need 6 million for that, ask for 6, but have a backup plan for why you need the 6. So that clear articulation of that is again important. I think in the space that we operate in, which is very, very tech heavy, quite important for us is to understand the competitive landscape. So we need to see, why is your technology better, different, more unique than the players out there? What's the advantage that you will have? The last point, which actually should have been the first point, is about the founding team and the extended team. So I think every slide deck will end up having who the founders are, but it's also useful to know what the extended team is like. I mean, you might be 3 co-founders, but you've already hired, let's call it 30 people. That's again validation for the fact that I know you know how to build teams. So that's good for me to know. So mention that in your deck upfront, that a lot of the money that we invest into you is not going to go into hiring the first set of employees, but you're already set on that front, and you're going to largely press the accelerator and grow your company. So that's good to know. So focus on that aspect as well. I'll move on to the nice to haves, which I would say is still think about it. But yeah, I think there's a question from Amitabh.
Yeah, hi. Hi, Niket. Thanks for this wonderful presentation. Can you go to the previous slide, please, if I may ask?
Sure.
Yeah, you can see how much time will a VC spend on the pitch deck, okay?
Yeah.
What do you mean by 3 minutes on a deck without a referral? What does it mean by that?
So we get a lot of inbound decks, inbound presentations that come through to us. If it has come through without a referral, like if it's from someone in our network or from a known connect, we end up spending more time, or we're more biased towards that. it's just a function of what's the filtration mechanism that we can use. So if somebody refers someone to us saying, hey, you know what, I've spoken to Amitabh, he's running a good startup. I've invested some money in it myself, and I think he's ready for the next round of funding. I would spend more time on that than a deck coming through to me, which hasn't been referred to me by someone else, because the sea of startups that want money from investors is very, very large. So we need to have some sort of a filtration mechanism. And like I was saying, it may not be fair, but it ends up being something that we give a lot of bias to.
But do you think, but sorry to interrupt, but do you think actually the deck goes with a referral? It doesn't, right?
It does. So,
It does? Okay.
because I would say, so for instance, so say you and I are friends and I'm not a VC either, and I'm connected to a VC, I would only recommend you or refer you to a VC if I truly believe that you're doing something good. And the reason I would do that is because if I send your deck to a VC who isn't, say, relevant for your startup, and my reputation is also technically at stake then if I refer something that isn't relevant to them. So I would, therefore, how I look at it is, every person who's referring something to me would have vetted something and are sort of putting a stake in the ground that they take some sort of onus that this is good. And I see that validation as one more sort of reference parameter for me as well to take a decision.
Okay, so that is not taken into consideration, you mean to say, right?
Say that again.
That doesn't, that means that is not taken into consideration in this case.
Not taken in, no, it is. No, I'm saying that if you are referred through someone, you have a higher chance of being noticed amongst 250 startups, and for a VC to spend more time on your deck than if you're not if you aren't sort of referred.
Sorry, I took it otherwise. Okay, fine. You answered my question. Thank you, Aniket. It's been nice. Thanks. Nice talking.
Thank you. Thank you, Amitabh, for initiating the first question. I'm sure that there's an icebreaker done now, and I'm sure the audience would like to.
That's always the hardest part. So yeah.
Yes, someone has done the hardest part, and let's have more interactive. Guys, if you have any questions, please raise your hands. We are open to answer. I'm sure Aniket is welcoming to more questions coming in there.
Yeah. Hi, this is KV Subramaniam here. I have a quick question. I noted one of your previous slides, Aniket, where you said about B2B. And you said, is that, I mean, this is more like what Idea Spring Capital is into? Or are you saying that there is some kind of preference to B2B versus B2C? If you can comment on that generally also.
Sure, that's completely sort of pertinent only to our firm and our thesis. So we need to basically have some way by which we have deeper conviction on certain areas. So our fund thesis, and even the way we have raised money. So even a VC fund ends up raising money from other investors. So we have raised money with the story that we understand the B2B space and we'll only invest in this. So therefore, investors have put money into our fund itself, and we would like to therefore continue down that focus path. But there could be some funds that do both. And so that's by no way, I mean, there's no limiting factor there in terms of this model only works for B2B. I would say 80-90% of what I'm covering is same for all, but my perspectives have been shaped by my experience in B2B venture space.
Okay, one quick follow-up, if I can, is in your view, given your experience, and it's amazing, how do you B2B versus a B2C?
Say that again, I think your voice broke off for about a second.
How do you view a B2B opportunity versus a B2C opportunity? Is there some kind of a risk factor associated? And just if you can elaborate on that, that would be great.
Sure, great question. I think it gets asked a lot in forums like this. So I think the primary difference is the fund structure as well. For B2C, you need a lot more money. You could manage with lesser, or you need a lot more money for sure, because a large part of B2C is customer acquisition costs. You end up, even if you see some of the biggest companies that have been built today, there was no monetization strategy for a long period of time, or there's no path to profitability for a long period of time because they only played the game of user acquisition and then growth. So B2B, on the other hand, is, I would say, there's a more viable, rational path towards profitability. So technically, even the margins that we like companies, even a company that I work for, Zomato, Zomato is a B2C company. You keep hearing a lot in the news about how the unit economics for a company like that are just not favorable in the long run, but they still believe that user acquisition happens today. They're able to use economies of scale over a period of time to bring those costs down. Whereas on the B2B side, we look at it very differently. Typically, at least software products in the B2B side, we can easily get a gross margin of 70 to 80%. So question of profitability isn't really there because technically every sale ends up being on a profitable basis. It's more a question of having the right networks and the right channels to sell to, which is a larger problem here. You don't end up spending as much on marketing advertising on the B2B side, where it's more of tapping into the right distribution networks to reach your end customers. So the sales and distribution strategy in B2B is significantly different, and you could do a lot more with a smaller fund. For a fund of our size, which is 250 crores or $33 million, there's no way we can invest in a B2C startup because you need a lot of money upfront to even get it out there. I mean, even for an app download and to get 1,000 people to download apps, you need a lot of money. Whereas on the B2B side, that's not the case. I think there are smart ways to sell. So we've fixed this as the focus, which is why we're able to invest with a smaller fund corpus as well.
Thank you, Aniket. Very well explained. Thank you.
Thank you. Participants, also, if you're good to mention your company, from where you come, that would always help in the forum like this. And I do see Kaushik has raised hand. Aniket, do you like to get with Kaushik's question?
Yeah, of course.
Yeah, Kaushik, over to you.
Hello, Ankit. Hi, it was a great session so far. So I have a small question. Say when we approach investors, right? What they expect is they want the whole team on board full time, right? So the approach that we have taken as a company is that since we are all college friends, half of the team is part-time in it, and half of the team is full-time in it. The part-timers fund the company, so we practically have a sort of an infinite runway going forward, and our growth rate was better than what we actually initially predicted. Do you think, as an investor, if we have a justification for why we are doing that at this moment, and if we say that we would transition, to full time in a month, will that be, a fair argument provided that,
Sure. I think there's a bit of disturbance, but I think I understood your question. So I'll answer along what I understood. But in case you need clarity, happy to have you correct me. So in terms of part-time versus full-time, yeah, I mean, we see that a lot. Actually, I think investors are fairly understanding of it because also we understand that you might be doing part-time because the uncertainty of a startup is very, very high, and without money coming in on a day-to-day basis, how do you run your homes and all of that? So what we look at is at least the main core team needs to be full-time committed, because if ultimately you need to have conviction in the success of your startup more than an investor is. So investor largely rides on the confidence that you are showing in the conviction of your startup or this thing. So you keep hearing about the casino, a term which is all in. So I think the more we see of you being all in as an entrepreneur, the more conviction it gives us that, okay, come what may, you are someone who can battle through the tough times and keep this company running and going. So, but that said, we don't expect everyone to be like that. So it's good that you have some people who are part-time who are working with you. But I would still say the main people need to be full-time, and before you reach an investor like us, I think there are other ways to also raise capital through friends and family, through angel investors, etc. I think if you need those rounds of capital upfront to get some people to come on board full time, then you are potentially more ready to pitch to an institutional investor like us. So we are rarely ever the first port of call when you need to raise funding. We are the first institution that you would raise money from, but there are other ways by which you can raise money as well to get people on board. And that's also validation for us that there were others who were along the process with you who put money into you because they believed in you. So, and that way you can maintain the right balance between part-time and full-time.
All right, thank you. Thanks for the clarity.
Great. So I'll continue with where I was at, and maybe after a couple of slides we could stop again for the next set of questions. So we covered the must-haves. I think nice to haves are also I would say mention it in your deck. Like I said, most decks should be between 10 and 15 slides. So you do have the first 5 points that I mentioned can each be covered in a slide of its own, but so you still have space to mention some other things. I think what an investor wants to see is how large an opportunity that you are playing. So by market opportunity, we assess that by what is the total dollar spend on a particular industry or a particular solution or a product at a global scale. So if a lot of people are paying for something, there's evidence that there is a ready market for it, and there is evidence that you will have customers, which is good. But that said, that's a safe way to look at it. There are also cases where you could potentially be creating a market for the first time. When Google launched and they were all about search engines and they didn't really have a business plan, and eventually they wanted to monetize it through advertising. If they had said at that point in time, hey, the market for online advertising is X, that X should have actually been a very small number because nobody was used to a model like that. So you could also, I mean, the really successful companies are ones that help create a new market or are able to see that a market could build up over a period of time. Example for just from the standpoint of our demographics, I mean, I think I read somewhere that recently that 60% of our population is still under the age of 28. So which means in the next 10 years or so, a lot of these people will be earning. If they're not already earning, they'll have money to spend. What will an average 28 to 38-year-old want to spend money on? Could be very different from what the market is shaped like today. So therefore, your market could be very different 10 years from now than what it is today, just basis demographics. Countries like Japan, for instance, have a lot of aging population. So their market could be shaped around products and services for that demographic versus something in India, which is more catered to the youth. So I think those are also good things to assess, some of which there is market data for which available today, some of which you'll have to create and convince an investor that, hey, market might not be there today, but it'll come up over a period of time, and both cases get funded. Business model is basically how you end up making money. I'll cover more on this in subsequent slides. But even if you don't have, I've purposely put this in nice to have and not must have, because we don't expect, I mean, WhatsApp is a great example, because WhatsApp, when it started, it was all about getting people on the platform to communicate, and there was no plan to ever make money out of it, right? I think initially they started with back in, I think when I was using it in 2010, 2011, they started with charging, I think to use WhatsApp, you needed to pay $1, but I think they realized that itself was a friction point in terms of adoption, that they went away with it and they didn't really think of monetizing. And now you see them having complementary business models to tap into the fact that whatever 2-3 billion people in the world use WhatsApp. So through payments and through advertising and all of that. So I think business model is important to have, but if you're onto something where user acquisition is sort of more key in the initial stages, we are okay if you don't have a business model today, but at least think through how it will come up over a period of time. And as long as you have that clarity in your head, it's good enough for an investor to potentially take a bet on you. I've purposely written pipeline of potential customers and pilots because we don't expect you to. A lot of the startups we end up investing, we have invested in 21 companies till date. 16 of those companies were at a pre-revenue basis. So there was literally no track record of whether their product can sell. But I think what gave us conviction was the fact that they have a product or a service that has an audience or a market that is interested in it. So we spoke to a lot of their potential customers. We saw pilots being run. They had potentially not started charging these customers as yet because I think they were working out the pricing strategy, working out or making the product better and better. But I think if we get a lot of what do you call it, validation from people who will eventually end up paying for it today and speaking to them. So we do a lot of these customer reference calls with our companies that we invest in, either existing customers or potential customers, to see what would they pay, how much would they pay, is this a product that they will continue using over a period of time, and then that helps us also develop conviction on it. So I think that always helps to showcase. Some of the mistakes is, I mean, just recently, actually 2 days back, I spoke to a startup that was trying to be another, what do you call it, super app. So trying to solve for grocery problems in a local community, also trying to solve for being a social media channel for the people within the community, also solving for payments as in a different system than using current solutions like Razorpay and Paytm, etc. So I think they were trying to solve too many things and they believe there's a market for it. I think if you try that sort of contradicts the first point on this slide, which is problem statement, in my opinion, should be very, very one-dimensional. You should have one problem statement and show that you can solve it rather than going after too many things at the same time. I think we typically end up saying no to startups which are trying to do too many things at the same time, because anyway, the propensity for things to change, to fail is high. So do that across multiple things that may break at the same point in time is, we believe, a difficult task. So do one thing, do it well, and then move on to the next thing is how we look at it. A lot of companies get into, at least in the stage that we operate in, they do the pre-revenue and they send us a 5-year projection plan on what revenue on a month-on-month. They get into such articulate details on, I mean, product isn't launched today, but they believe in January they'll do X revenue, February they'll do X+2, March X+3, and so on and so forth. Now that to me is fairly premature. We specifically, even in the, like I said, we invest in a lot of pre-revenue startups, but validation of your pipeline of potential customers is more important to us than saying what revenue you'll be making 5 years down the line. A lot of companies don't even last 5 years. So for you to say that is the case without showing or without there being any proof in the pudding is a little premature in our opinion. Now this is, I've highlighted it as a mistake, but I would say purely from the standpoint of our fund, which is very early stage. In a lot of late stage startups, of course, you need to show that a lot more, because at the stage where it becomes attractive to private equity investors, etc., you need to show that, and you have number crunchers who are able to sort of run models or create models and see what is the worth of a company today basis projected revenue, etc. We don't do any of that sort of stuff. The last thing is not demonstrating ability to execute. Execution in our mind is always better than idea. You could have a great idea, but if I don't have conviction that you can execute, again, pipeline of potential customers is your ability to execute. Running pilots is your ability to execute. Potentially lining up partnership channels is an ability to execute. All of that may not lead to sales today, but if you're showing me that you can do all of that and aren't just waiting for the check to come in to start doing all of that, that again is greater validation for us. I see some chat. I can't read it though. Do we have questions or can I move on?
Yeah, you can move on. The chat, I would read it later. It's more of a compliment.
Okay, sure. So these are, I would say, largely what you would need to consider while making a pitch deck. I will then show you or share or give you an insight into how we evaluate a lot of this stuff. So we actually use a fairly methodical 10 criteria rating scorecard that we have created in-house to evaluate companies, and I'll take you through each of those points. It's sort of the same things that I showed you earlier, but these are actually the 10 parameters that we use. So strength of management, we spoke about how important the team is. How do we know? The question that we ask, so the first column is basically all of the parameters that we use. The second column is the question that we want an answer for by looking at your pitch deck. And the third column is largely guidelines that we use to figure how to rate you. And I'll take you into our rating scorecard also, which is in the subsequent slide. So strength of management is, how do we know? Basically, we need to know that your team is great to solve this problem. Are you from the same industry? Are you from a good academic background? Do you have good corporate credentials? Have you done a startup in your past, which is very sort of relevant to what is it that you're doing again right now? Also, for instance, if you are someone who ran a restaurant and tomorrow you want to run a cybersecurity company, even if you've had success in running a restaurant, I don't necessarily think you're the right person to start and run a cybersecurity company, even if you've got the right team, but you are the one calling the shots. Whereas if you spent, let's call it 10 years in a typical FMCG company, let's say Unilever, and you were doing small roles, you got a good exposure across the breadth of what the company does, and tomorrow you wanted to start your own D2C brand. I would say, even if you didn't do your own startup experience and you didn't have great roles within that, that direct sort of relevance to what you were doing previously is something that we hold highly. So that's important. And just on this point, maybe I can show you how our rating scorecard works. So we rate every startup on a scale of 1 to 4 on each of these parameters. So 4 being the highest rating. So we just spoke of strength of management, which is basically another word for team. So if it's the first time you're doing something with only 1 or 2 people with limited relevant industry experience, we typically give you a 1. Now you might still be the next Mark Zuckerberg, but fortunately or unfortunately, we need something objective basis which we will have to assess you to take you forward. It ends up being like that. And yes, every VC firm ultimately ends up missing out on good startups just because they probably didn't end up scoring well on a scorecard like this. But this is what it is, at least for a larger, I would say 70-80% of our startups, we still sort of subject them through this to see if we are able to at least large mean of startups, at least we're able to ensure that they go through a proper methodical evaluation process. So we saw what a 1 rating for a team is. A 4 rating would be seasoned entrepreneurs. You've done a startup before. The team is also fairly complementary in nature. There's someone potentially heading technology, someone doing sales, someone with management experience, and there's a good solid track record of what you're doing. I mean, Kunal Shah is a good example. He started what was his company? Freecharge, right? So he started Freecharge. He sold that to Snapdeal, I think it was. He sold that to Snapdeal.
From there, Axis Bank.
Okay. So when he sold it to Snapdeal, and then when he wanted to start his next venture, which is Cred, just his credentials for having run a successful startup was good enough for him to raise funding. A lot of these successful entrepreneurs could theoretically end up raising their next, for their next company, they could end up raising money with just an idea. We go into the focus, or we emphasize a lot on what the larger public needs to do to get a startup off the ground. But if you've shown success in the past, yes, there is going to be a strong advantage that you have, at least in terms of raising capital, and you can do that easily. So someone like that who comes to us who sold a company in the past, we would rate them a 4. But most of we've funded companies even where the team has ranked as little as 2. just because it could be in an area where nobody is experienced. I mean, I think we spoke about some areas that are potentially coming up. I mean, if take cryptocurrency, for instance, we've still not seen what success in that space is. And anybody who's getting into that space won't obviously have even let alone a decade, but won't even have 3 to 4 years of experience in that space. But if we believe they have the acumen to make a dent in that space, we potentially rate them at 2, and we can still sort of rate the company or invest in the company. So I wouldn't say that only 4s get funded or 1s don't get funded. Sometimes we do make exceptions, but this scorecard would at least help us filter out and get to those, let's say 20% of companies that we might need to look at more closely and have further conversations to figure out if we have differing opinions on something like this. I'll cover some of these and we can go back to that scorecard, but technology, we are obsessed with it. It needs to be proprietary. If it is outsourced, we typically don't end up investing in new. There are a lot of advantages of outsourcing technology. I mean, we've spoken to a great set of companies that have great business people running the company, and there are good sort of tech companies outside that are building their product and managing it, etc. It's a great model, it works for them, but it doesn't work for us. So again, try and find the right VC who works with or believes in the ethos with which you've set out and scaled your company. Market size and demand, I think spoke a lot about it in the previous slides. I won't go into it again. Competitive advantage, yeah, we want to know why you are very different from the others. I think I have, I'll maybe go over competitive advantage in more detail here. So we have, I think you all must have heard of Blue Ocean strategy. There's also a Red Ocean strategy. So Blue Ocean strategy is basically you are in a market which does not have any competitors, and you are therefore trying to, there isn't really anything to disrupt per se, but you're trying to create a market. And you are one of the first players in it. So those sort of companies we look differently. But Red Ocean is, I mean, today, for instance, somebody comes up to us and says that, hey, I'm also starting a e-commerce marketplace to sell clothes or electronics. The idea today isn't as novel as it was 10 to 15 years back. So today, for instance, if somebody comes up with that, we'd probably say there's a very high likelihood we'll say no to them upfront, because I think they aren't able to assess why there is still a market to do something like that today. Are you doing something differently about it is what we want to establish. So which is why if you see our ratings of 1 to 4, 1 is that Flipkart example that I gave. There's already an established e-commerce market. There are a lot of players operating in it. There are a lot of strategies already in play. It'll be, even if you're onto something unique and you are convinced and ready to take it to your grave, it might be difficult for you to convince an investor like us, or maybe even other investors. So keep that in mind when you are entering a place that already has a lot of competition. You could end up, I think we like opportunities which are, let's say, in the space of 3 or 4, where, see, 1 and 2 could be competitive market, but you could be doing something drastically different and we could still fund you. But 3 and 4 is, we like it where, but I would say in 1 and 2, the scope for the whole market to grow is low. So take, I don't know, food, for instance. There is only so much money that is spent on food on a year-on-year basis. That's not something that's going to grow exponentially. You can't say that food consumption next year is, let's say, 3x of what it is this year. It's likely to grow at a sustained pace, whereas some sectors could really take off. I mean, crypto is a good example, or the metaverse is a good example, where even year-on-year growth from now to 3 years back, you could actually see 200-300% growth, because it's just a new untapped market. Now, the risk associated with that is it could be a market that never really takes off and that never really ripens. But that's still something that we are excited about, and we encourage people to think bold on those fronts and say that market might not exist today, but it's really sort of growing. So that's how we rate sort of companies. And then if you also have a lot of our companies, I think I missed out one point in the Idea Spring slide, where across our companies, we have, I think, about 25 to 30 patents already. And a patent is basically something that gives you some ownership or right on the technology that or IP that you've created in-house, which gives you that competitive advantage. Nobody else can replicate it. So something like that also is advantageous for you to have. And if you have something on that front, I think it's again useful for us to know. I think some of the other points we've covered it. Business model we covered, traction also we spoke on in terms of how much revenue you're doing today, but more importantly, you want to know what is your ability to execute. Catalytic capital is how will this money help you get to your milestone. So more often than not, we look at it from the next milestone that you have. So today we are investing in you, but tomorrow you will be seeking money from a Series A investor, and that's not an area that we specialize in. So we know what are the metrics that a Series A investor looks at. So they look at more of revenue, milestones, etc., that you hit. If the capital that you're raising from us today won't help you reach those milestones, then we probably won't invest in you. Or if we don't have the conviction that you'll hit those milestones, we won't invest in you. Also, I think risks are important to assess. Nobody can sort of say that there is no risk associated with the startup that they're doing, but as long as they have a plan in place to mitigate some of those risks, I think we see that to be realistic and something that we should look at more closely. So like this, we have a rating scorecard for different parameters. I think I've shown you for some of them. This is actually my last slide. So I know we've overshot on time, so I'll quickly cover this. So after we've done due diligence, which is all of this stuff, we take that final decision to invest. So everything looks good in terms of the company, in terms of the team, in terms of the market. But then we need to take a call on how much do we want to invest. So those are also decisions basis which we could pull out at the last moment. So for instance, if a company is raising 3 million, we might, even if, like I said, our thesis is largely to invest only 1.5 million at most. But in a market or in a company where we don't believe we can add too much value, or that we believe could benefit from the guidance and mentorship of other investors who are more specialized in the space, we might be willing to write a smaller check. So even in the 3 million raise, we might only put in about 750K. And we want to see some other bigger investors come in. And if the bigger investors don't come in, then we don't end up putting money either. So that's something around how much we want to invest. Desired stake is basically how much % of company we want to own after for the money that we're putting in. It's a function of how competitive that market is. Some sectors are doing much better than some others. So if it's a hot sector and we still want to get in, we should be okay with writing a larger check, but getting lesser equity. Cap table is basically who owns shares in the company already today. So sometimes it's actually a big mistake a lot of founders do is they dilute a lot of money, dilute a lot of equity upfront itself. So we end up seeing cases where the founders only own, let's call it 50-60% of the company. 40% has already been given out to friends and family, angel investors, etc. And then when we get in for 15 to 20%. So that dilutes the founders further. And we want the founders to have enough skin in the game. So if you don't have enough skin in the game, we don't believe you will stick through the course. So ensure you don't dilute too much upfront, and that's also something we have to keep in mind. So we don't try and take too much away from an entrepreneur, because we know that the Series A investor will think that they got diluted too much. So we know how much it is that we can take and how much it is that needs to stay on the cap table for the next investor to be excited. And that's also a reason basis which we make a decision on whether to finally invest or not. Who else is investing? I think we covered it in the previous point. If there's somebody else who is competent in that area, we like to partner with them. We end up doing that. And term sheet, basically all the other caveats. Sometimes we put revenue milestones, sometimes we put how much salaries they can draw, sometimes we put basically it's a fairly long verbose document drafted by lawyers, standard to a large extent, but customized on a case-by-case basis. So, so final investment decision is taken along these parameters after all the due diligence is sort of done. So, yeah, that's about it. So, happy to go back, cover any of this, or take any other questions.
Thanks, Aniket. That was an insightful session. If you don't mind, I will put you on a spot. I'm sure that there was a slide which we mentioned that reference does hold a few more minutes for the glance for the investor. You have shared your email address as well in the first slide. Are you open to share it now so that the leaders and the participants here could view the email address if they would like to wish to connect with you?
Yeah, sure. I'm also fairly active on LinkedIn, so if you could again mention that you.
Sure. Let me share the LinkedIn link as well.
Yeah.
Just a minute. In the meantime, anyone who has a question, can you please turn on your screen and ask the questions for any of the slides? Or any follow-up questions from the leads who have asked? Yes, Vinod has a question. Let's take it from Vinod.
Hey, Ankit. So it was a great talk actually. So just actually starting a startup. So it was a really great insight for me to understand like how the VCs think and how the pitch deck look. So my question is like, I have checked your portfolio, most of the startups and everything, and most of those startups were headquartered in US. So would you guys prefer that, or just even if it is a company is like founded in India, registered in India, would you prefer that? Like, is it like difference? Like, would you
Actually, we prefer Indian companies. I think we strongly prefer Indian companies. There are also some regulatory considerations we need to factor in before we can invest in a company abroad. More often than not, we end up investing in an India entity. And if the market for the company that we invest in happens to be in the US, then they set up a US entity and then potentially change the headquarters. But yeah, we definitely want to invest only in Indian companies. And even the RBI and SEBI are tightly sort of govern fund structures like ours and ensure that we aren't investing, or ensure that considering we're raising money in India, we don't end up investing too much of it outside. So there are certain limits that we need to abide by as well. So we can invest in some amount of companies abroad, but we prefer India. And if the market happens to be global, well, that's good.
Got it. That's good. Actually. Yeah. Thank you.
Thank you, Vinod. Let's explore if we have more questions.
Aniket, it's a really wonderful talk you have given, and in fact, you shared it from your heart and your experience, rather than just superficially how to really make a deck. You really gave a pretty good insight. And in fact, while you was talking, I was making some of the notes as well. So most of the startups, they find some of the typical problems. I know that time is already over, but if you can really throw some light, number one problem, how do you really find the founders, right? Typically, that's one of the major issue with the startup company faces. And the second, you also highlighted one point that yes, founders should not really shell away a large amount of the equity because you don't have the flash in the longer run. So how do you founder actually decides the equity distribution to other co-founders?
Okay.
Not a straightforward answer.
Yeah, no, I'll answer your second question first. So I think when a company is incorporated, a lot of time needs to be spent by the founders to figure out who's going to add what value to the company. It's not just among themselves that they need to reach that agreement, but also over a period of time, that question will keep sort of coming up with other folks as well. So we have actually encountered companies where we've had to say no to funding them because somebody might have been relevant to the company in the past. They probably spent 3 months, 6 months with the company. They were called a co-founder, took away 5-10% of the company. They're not involved anymore. So 10% of the company is just locked in with somebody who plays no active part in the company. So that in our mind is sort of founder dynamics that didn't sort of pan out very well upfront. So a lot of this can be corrected later as well. Sometimes an investor gets in and has a discussion with the active founders and tells them that rather than you all diluting, can we get them to dilute and we compensate them in some way. So those sort of arrangements do exist, but it gets messy. So yeah, we try and ensure that we invest in non-messy structured companies because it just leads to lesser problems down the line. Sorry, what was your first question?
The first question was, how do you start this second problem? Identifying the founders.
You mean
co-founders, identifying the co-founders. Let's say a lot of people come up with a great idea, right? But they don't have the team. And I think you're one of the highest weightages on the team because that leads to the executional power.
Yeah. So I think that is that's not a thing that we end up spending too much time on. We want to see sufficient evidence of it upfront. We really actually one point that I didn't mention that we give a lot of weightage to, and I think a lot of founders also do it really well. One of the first points that they present in their pitch is, okay, I am so and so, I head technology. This is so and so, he heads business, and we worked together for 15 years. We've done startups of our own. We worked in our previous company. That by itself gives us a sense of comfort, that because it's very easy in a startup for founders to have a rift down the line. And there are a lot of new entities today that allow for founders to meet one another and then partner up and start a company. In a lot of cases that can work, but see, a startup is something that people end up spending all their time. I mean, you need to be, I'm actually saying that one needs to be 120% invested into it. So in terms of time, personal life, your spouses should be okay with it and all of that. So that said, you're going to be spending a lot of time, potentially more than with your spouses also with your co-founder itself. So that rapport is something that we try and gauge upfront. So actually, even when we do reference checks of companies that we end up investing in, we try and find out how do these two work closely. We try and understand those dynamics more closely. So if the founder comes up to us and says that, okay, I know how to solve for this, but I don't, but I acknowledge the need that I need someone to complement me on these certain skill sets, and I need to still find that person. We don't really play that role of matchmaker in that case. I mean, we say that find that person, show us evidence that you guys get along well, and then come back to us and we'll still look at you. Because that's not something that we should be sort of telling them, because that's too much of coaching or
no, certainly. But don't you think that can also be resolved once they have the capital? They can always hire.
Yeah, so hiring, correct. So hiring is very different than co-founders. So founders, we treat them on a different level. Key hires is different. See, founders also come with that whole equity component and all of that, right? Where a lot of it is locked up with them. Hires are people who will potentially, even if they're key hires, they will have ESOPs. ESOPs will have a fairly long vesting schedule. So there are still ways to correct mistakes that you might end up making in terms of bad hiring. But founders are on all the legal documents of the company, and it just becomes more difficult to sort of manage that if there's a rift in that case.
Wonderful, Aniket. There's another last question. So there are a lot of companies. So you highlighted a very valid point that majority of the startup, they make big mistake which they don't realize that they create a lot of revenue forecast without earning a single penny. That's the extreme case. How do you really see the other case, which is between 0 and 1, where they have some nominal money, but still the product and pricing is evolving, right? And it's based on that they create the future cash flow forecast, which may or may not really be validated. How do you see that?
Good question. Sure, great question. So I did that with a company recently where they were making some money. They were making about 50 lakhs, I think, on a yearly basis, which isn't great money or it isn't validation for them having achieved product market fit.
Right.
I actually sat with them and asked them to chart out a plan to me on how they will hit 1 million in revenue and in what period of time. So they
Right.
came back saying they will hit 1 million of revenue because 50 lakhs is a small amount, right? It's not even 1/10 of
Right.
a million. And 1 million, they said they can hit it at the 18-month mark. And I said, okay, great. Now show me what pipeline of customers that you have. Who are the conversations you're having? So they actually prepared an Excel sheet for me with saying that, okay, I'm speaking to so-and-so companies. If this converts, I will get this much. So fairly well methodical exercise. We still unfortunately had to say no to that company because I thought the two weren't in sync. Today where they are and seeing with the sales that they had done in the last 6 months to get to that 50 lakhs and to get to that 1 million mark, and they came up with a 1 million number themselves. I didn't think that they could actually hit those month-on-month numbers. So that was a case of, and that pipeline wasn't strong. That was the biggest reason. It wasn't as though that all the customers that they've mentioned in the pipeline would convert. Some of them could take 6 months, 9 months. So also, but they had projections saying that from January 2023 onwards, they'll start getting this much revenue. So in that sort of a case, I think the pipeline holds some value and the ability to sort of say that they'll actually convert some of those customers. And I actually spoke to some of those potential customers, and they were also, I think the company was rightly optimistic in saying that they will convert, but I could get a sense from the potential customers that they're still piloting and they don't know how much they'll spend. Even if they'll start small. So I didn't think those numbers could be hit. I mean, it could still be a bad miss at my end, and my assessment of it could be wrong, but you
have to do fairly some good risk assessment.
I learned to live with the mistakes I make on that.
Wonderful. Wonderful, Aniket. I'm really tempted to ask you a lot of questions, but I'll stop here.
We do have a question from Indrajit, who is raising hand from long. Indrajit, if you could turn on your video, thank you. Let me add a spotlight to you.
Hi.
Hi, Indrajit.
Hi, Aniket. Thanks for a very insightful presentation. It really helps. I am a new founder. I mean, I just started up last year. My company is Aspic Innovations Private Limited. The question I have is related to the slide where you mentioned about the must-haves, the nice-to-haves, and the mistakes. And I noted one of the mistakes is not to show a revenue projection for a pre-revenue startup. So the question is, how do you gauge revenue potential in the first initial deck a startup shares with you, if there are no revenues yet?
So that's okay.
Or is that even important?
Sorry, what did you say at the end?
No, I was just adding on. I mean, or is that something you feel is not so relevant or important for that first review of the pitch deck?
Yeah, I think it's not exact numbers is not relevant. A business plan, and I think the point that I was discussing with Mr. Daheria as well on pipeline of potential customers, even if they're paying zero today, are you running pilots with them that could help them convert to customers? To me, holds more weightage than you saying month 1 to month 48 for the next 48 months. I can say this much revenue they learn, this much cost. I mean, that's your typical financial model that all these number crunchers in investment banks have, right? That, in my opinion, is more relevant to a more mature company, a company that has a track record of revenue, that understands that revenue is growing at a certain pace on a month-on-month basis. So therefore, they can make projections to say that it will continue growing at the same pace or it will increase, decrease, depending on external factors as well. But when all of that data doesn't exist and you are anyway just shooting a number in the dark, you can. It's just that we don't give weightage to that number. If you have the other aspects that I mentioned covered, we might still invest in you, even if you gave me a redundant slide on revenue projections, but these other aspects to me matter a lot more.
Okay, thank you. A related question very quickly is how do you then do a valuation for the company to arrive at the state question, which was covered right at the end of your
Great question, and question keeps coming up to us as well, because we end up speaking to. So I think there is in this there's no science to it at all. It's largely going to be a function of. So we look at the cap table. We firstly ask how much percentage of are you willing to dilute, which ends up becoming how much they will give up if we were to put in money. So ballpark that we operate in is for our 750K to 1.25 million. We look to get anywhere between 15 to 20% of the company. That's a ballpark number. If anybody is exceptionally higher than that, we typically say no, and that's could be a case of them being overly optimistic, or it could be a case of us not thinking that they are worth that price, or it could be a case of them just commanding a high valuation because they have a good track record. So, and we're okay to miss out on some of those things. But I think another thing is comparables in the market. We keep seeing, let's take the generative AI space. There were a lot of deals that were made in the recent past. We have some insight into what valuations those deals were made at. I think if the company that we are evaluating is in that ballpark range, we at least understand that companies are, for us to want to play in this market, we will need to shell out this much. If it's very different from that ballpark range, we ask the company to justify. If they have a good justification, we still end up investing in the company at the valuation that they want. But there's a certain percentage that we want, there's a certain percentage that they are willing to give. More often than not, I would say it's in a good ballpark. It's in the same ballpark. So I don't think small percentage points is something that we discussed today. I mean, conversation 1 is never about, or conversation 1 to 5 with a particular entrepreneur is never about 17% versus 18%. I mean, it is more of, can you talk of something in the 15 to 20 range? Now, towards the end of that towards the end of 3 months of evaluating the company, if we still think it's 15, we still think we want 20 and they want 15 or 16, they want only give away 15 or 16. I would say that's an easier conversation to have, because each of us realizes what value the other is bringing to the table, and we can reach a point of mutual consensus. But that's harder to do in an initial conversation, which is why if the range is too varied, we are okay to say no upfront.
Thank you. That really helps. Thanks a lot for your answers.
Thank you, Indrajit. The time is up for the Q&A and session. I'm sure most of the people have a lot of questions. You can get connected with Aniket, and LinkedIn details have been also shared on chat. Along with this, we would like to thankful to Aniket for joining for a Saturday, where most of the people are actually on travels, and being part of the session and being open about how they can improve their pitch deck. Thank you, Aniket. It's we had a great time, insightful session, and you could see the compliments in the chat box for sure. Just one KVS who had just asked you a question. He said an excellent session. Amitav, a lot of people are giving a lot of compliments to you in terms of the session. Thank you for joining and being supportive for this initiative.
No, my pleasure, and appreciate so many people showing up on an early Saturday morning. I think Vignesh and I were trying to find a spot that worked best for us, and unfortunately I could only do it this morning, and I understand that your sessions have had a good turnout in the evening. So, but good to see so many people, and I loved the questions as well. It helps me make this pitch sort of more perfect even for the conversations like this. So appreciate the feedback that I've got as well.
Thank you. Would you like to join more for a session like this? I'm direct pitch.
Let's keep in touch and discuss.
Sure. For those reasons, I have shared a link in the chat box for the participants. We're going to do a lot of sessions like this. I'm sure Aniket would be not the one time we could view it. I'm sure we would have continuous support from Idea Spring, and we look forward for more engagement sessions. Do let us know the topics you would like to learn. I'm sure on YouTube there are a lot of topics, but nothing like this, what we could see today. Interaction with the real investors, trying to identify how you improve your pitch deck. We have sent a link in the chat box. Please do copy the link before you log out. And we also asked you to please share the topics you would like to hear. We would like to build it for you and startups in this. And there are almost a good number of startup co-founders who have joined. I'm sure that everyone with their notes and trying to identify the best. The session is also recorded on YouTube. If needed, we would share the link. Please do share the